So you're looking for homes to buy and you're considering rent to own. Please watch this video. You have to know what I'm about to say. Hey, I am Mr. Maciek. Welcome to the channel where we talk all about making money, investing in real estate, and in general, what can you do to build your financial wealth. Now, please stick around near the end of the video. I'm going to tell you the secret to getting around everything that I'm about to warn you about. So the topic is about rent to own when it comes to buying property. And for some reason, you can't purchase a home, whether it's that you don't have the down payment, you don't have the credit, the employment history, or just in general, you can't get a loan. So you found a property that is available for rent to own and you are considering it. Let me first break down what is rent to own. Now, YouTube Analytics is telling me something very interesting. A whopping 70.1% of you who watch my videos in the last 28 days are not subscribed. Please subscribe below. Let's change that number and help my channel out. So the official term of rent to own is actually lease with an option to buy. And it's just what it sounds like. You're actually leasing the property, aka renting still, and then you are purchasing an option to purchase it. And what is an option? Well, it's really simple. It's actually just an agreement between the buyer and the seller, where the seller agrees to sell to the buyer the property at a certain price in the future. And usually that future is laid out exactly when is the latest date that they can buy it. And should they not buy it, should the buyer actually not fulfill the option to buy, it's not an obligation, just an option, well then the money that was paid for this option is lost. So let's get into some examples. Now the example I'm going to use is a property, let's just say a single family home that is for sale as a lease with option to buy for a total of $200,000. And here's the way it works. Usually you go get yourself a loan. You go to the bank, but for whatever reason you can't get the loan. So therefore you're negotiating with this seller. And with this $200,000 purchase price, here's usually what happens. Two things. One is you have a lease agreement and then you have an option agreement. And they're signed simultaneously, but they're actually two different documents. So the lease agreement is just a rental. That's all it is. Let's just say this $200,000 home rents for $1,500. And the other part of it is the option. And for the option to purchase this home for $200,000, and as an example, within 24 months or 36 months, you agree to pay to the seller $15,000. That is a going rate for a $200,000 piece of property. So you're still following me? You signed a lease, you're renting the property, you sign an agreement to buy it within a predetermined time frame for $15,000. Now in most cases, this $15,000 is the down payment that a lot of first-time home buyers have. So why is it dangerous, or where are the pitfalls of lease options? Because at the surface level, and when all people are honest, it's actually a great option. It is a rental while you figure out why and how you can get financing. So let's go into a little more detail here of what you really need to watch out for. Because this industry has kind of led the lease option people to be, predatory. So now that we understand what a lease option is, let's talk about some of the pitfalls that you can encounter and what has happened in the industry with sellers who are offering a lease with an option to purchase. First of all, the home is most likely overpriced. And here's why I say that. It's because if this seller really wanted to sell the property and it was at fair market value, a regular buyer that can get a loan would go and buy it. But the seller is apparently wanting a little more money than the market is bearing. So they increase the price a little bit and offer a lease option to buy. So once these sellers put an ad out, what they do is they look for someone who is really desperate and vulnerable. And one of the signs of it is that they ask all the right questions to find out, can you qualify for a regular loan? If the answer is yes, they might not want to deal with you. And how desperate are you? How much do they feel from the conversation that you really want a home? Are you willing to overpay for the rent, for the lease part, in order to get this house? So what they do is they will actually have a higher rental rate than the home would bear. So usually this home, this $200,000 home example, might rent for $1,500. they're going to bump it up to $1,650 or $700. And they're going to tell you that that extra $200 is going to go towards your down payment. And that is true if you get it all in writing. But the probability of it actually going through is not that high, although it's there. And why do I say the probability is pretty low for you to actually go through with the financing and buy this home? And one of the reasons is that sellers sometimes know that this property will not qualify for financing. Let me give you a couple examples. There might be a roof problem. So as a renter, because you're leasing and you are a renter, you're not going to go and replace the roof. You're not going to spend $8,000, $10,000, $15,000 on a roof, right? It makes no sense. You spend that money on a roof after you've bought it, not before. But you may not actually qualify for the loan itself. And in a desperate attempt, since you've paid $15,000 and you've been renting for, let's just say, 2 years at an overpriced amount, that you might actually go and spend additional money to redo the roof of a home you're not even the owner of. So this seller might know about things about the house that will not qualify for financing. And it's really kind of comes back to won't qualify for the minimum standards that loans have for the home, or it won't get insurance for whatever reason. And there's a lot of different things in a home where you might not be able to get insurance. Let's just say an evidence of a little sinkhole, or let's just say cloth wiring is a problem, or a whole bunch of weird electrical things or plumbing situation, or an active roof leak. These are just a few examples of why you might not be able to get insurance. And if you can't get insurance, you won't get a loan from a traditional bank. So just a quick recap, you might have a predatory seller who knows their property is not going to finance, and they're also overcharging you for the rent, telling you that that extra overcharge is your money if you fulfill the whole option to purchase. And I think those are all very important points, but what is more important are the what ifs of the scenario. And I'm not a naysayer. I'm definitely someone who says, yes, go for it, fulfill your dreams and take action, right? But these are some things that even I will say, wait, what if? And you need to be aware of how to deal with these particular situations. So let's go over a few here. Okay, so just to fill a little more in on the example, we are buying a $200,000 home, we're renting it for $1,700, and we have a $15,000 option to purchase that we paid for, and now we're in a position that the market goes down. So what does that mean for you? This is the what if. What if the market goes down? And what I mean by that is prices go down. So this home, which is already overpriced at $200,000, is most likely worth $190,000 or $185,000. And now you are in a position where the market has gone down. And let's just say it went down from the 185 to a 175. And you go to a bank or your credit union, someone you have a great relationship with, you tell them, okay, I'm ready to buy the house. I had a 3-year time frame to buy. I have been renting for 2 of those years, and now I have 1 year to figure out my financing. Let's talk. And the bank says, well, the thing is, after we do the appraisal, we found out that it was worth only $175,000. But you have an outstanding balance of $200,000. In the best case scenario, you actually have an outstanding balance of only $185,000 because the option purchase price of $15,000 was credited towards your down payment. And as an owner-occupant home buyer, there are different loan programs, one of which is a 3% down conventional loan, if you qualify for all these other things that are required with it. But let's just say it's only a 3% down. So now you're purchasing a property for $200,000 and it is worth only $175,000. And you're only going to get a loan of 95% or 97% on $175,000 because that is the loan program. They're going to lend you 97% of the purchase price. So the bank is willing to lend you 97%, which is $169,750. So you may ask yourself, wait, I'm buying it for $200,000. Who's paying for the rest? And the answer is you. That's the problem. This is the pitfall that could come from this. So this is the what if that you really need to pay attention to. Do you think that within the time frame of your option, prices are going to go up or are they going to go down? In the last 10 years, we have had price appreciation. So the bank says, I'm only lending you $169,750. You're buying this for $200,000. So who's going to pay the difference, $30,250? Well, you've already given $15,000, probably paid down another, $2,000-4,000 in your increased rental rate. So it still leaves us a little over $10,000. Who's going to pay for that? And the bottom line is it's you. And if you don't have that money to bring to the table as additional money, then unfortunately you will not be able to get a loan. And therefore, you're going to forfeit your $15,000 and you're going to forfeit all this additional rent, not to mention the actual rent that you have been paying for the last couple of years, with the hopes that this was going to be your home for your family. And now you have lost not only the down payment, but also wasted 2 years of your life trying to hope and plan for this great plan that you had. But this video hopefully will keep you from having this problem. Now let's go over another what if. What if interest rates go up? Right now we are in January 2021. Interest rates are 2.75% for a 30-year conventional fixed rate. If you're making all your calculations and estimates based on 2.75%, realize that in 2 years our interest rates might be higher. This is just a what if. What if interest rates go higher? What I would do is when I'm doing all my calculations and talking to lenders to see if I'll qualify for certain dollar amounts, I would let them know to assume that we're going to have a 4 or a 4.5% interest rate, because it's better to be safe than sorry. And when they're going to do their calculations of your purchase amount or whatever the loan amount is on 4 or 4.5%, your payment's going to be higher. But if you qualify with your debt to income ratio with that number, then you're really preventing yourself from falling into this pitfall, this what if the interest rates go up. Now let's talk about another what if. What if after you've applied for the loan and you're going through the process, an appraisal is done and the appraiser comes back and says, look, this thing is valued at, $200,000 or $190,000 or whatever the number is, after a certain amount of repairs are done. And they will actually list out the different types of repairs. FHA loans do this all the time too. And if you have termites, forget about it. You got to treat all of that stuff. So when it comes to the appraised amount, sometimes it's contingent upon certain repairs to be done. And now who's going to make those repairs? Are you going to make them as somebody who doesn't even own the property yet? I don't suggest that, and I do not recommend my clients to do this. So you really have to know, is this property financeable? And it's really hard to know. Maybe you just need to go and talk to a couple of appraisers and have them come in and look at your property, or just hire one to make sure that everything is good. Or do an inspection prior to you entering this lease option agreement. Make sure that you know what you're getting into. All right, one more what if. What if you have a career change? Now, I don't mean that you got a promotion in your current job. Maybe you were working at some grocery store and you got promoted from VP to president or whatever. I'm not talking about that. I'm talking about a career change. What if you have been working as a waitress and for years while you've been going to school, and then you start a nursing career or some other profession? Now, this is a completely different industry, and the way banks look at that is unfavorably. Even if you went from earning $20,000 a year to $45,000 a year, they're still not going to take this income as a qualifying income, unless you have 2 years of experience with this industry. So what if you have a career change? You've gone into this lease option agreement, you're renting, you've paid the $15,000, now you got a job, you get more money, you can easily afford it, everything is going great for you, you've even improved your credit score, but then the bank says, no, we're not gonna lend you. You just started this job 1 year ago. We just started this job 18 months ago. We're still not going to lend you the money. We need 2 years, 24 months of income in this new industry. So sometimes it's a curse in a disguise of a blessing that you are moving up in the world and you're really doing what's right for you in your career. But then the bank penalizes you. And I don't understand this too much. It's just all about the risk management for the bank and for the loans and the resell ability of these loans to Fannie Mae. But really, that's how it works. So if you're planning on having a career change within the time frame of the option, then maybe you should reconsider and go talk to somebody. Talk to a real estate agent. Hey, reach out to me, comment below. Let me know what questions you have. I'd be glad to answer you. And now, drum roll, please. What is the secret to getting around all these problems? Well, here it is, ladies and gentlemen. When you are going and talking to a seller who has an advertisement for a lease option to buy, you get everything in order, get everything figured out, and then at the end, you ask them something. You say, Mr. Seller, Mr. and Mrs. Seller, I love this home and I'd love to come into this, but instead of you dealing with all the repairs for the lease option term, why don't we just do this? We'll keep all the terms the same and I will buy this property from you. But what I need you to do is I need you to owner finance me, and I'm gonna give a $15,000 down payment, just like you did with the other one, and I'm gonna ask you to just hold the note. Now, when you word it that way, they don't always know what that means. So you ask them to hold the note, which basically means owner financing. If you propose it as owner financing, many times people get turned away because they just don't know what it is. So the way I say it is, how about this? I'm gonna help meet your goal and you're gonna help me meet my goal. I'm going to pay you a lump sum payment of $15,000. I'm going to ask you to sign over the property, and in exchange, let's protect your interests, and we're going to have a mortgage. And in this mortgage, you're going to get paid 4% or 3% or whatever it is over 30 years, but I have 5 years to go and pay it off. Or maybe 3 years or 2 years or whatever the lease option term that was proposed is. That's what you want to do. You want to match all the terms, right? Except the only difference for them is that they're not going to be getting a rental rate. That's all. And they don't have the opportunity to steal your $15,000 because some of them do that. So once you propose it as not a lease option to buy, but figuring out all the terms and then suggesting a owner finance situation, or holding a note as I call it, then you might have a good chance of actually getting that one. And here's the beauty of it. When you go to refinance it in the future, you go to a bank, you don't have to go and put down another 5% down. What they do is they just go and appraise it. And from the appraisal amount, then they can give you the loan. And there is a little more stipulation and a few more things that I'm not going to go into depth with in this video. But it's really important for you to know that this option exists. It's the secret. I've done it numerous times, literally. I just did it in November, a couple months back. So it's really a great option. If you have any questions about it, please comment below. And really, if you're thinking about lease option to buy, you probably need to watch this video right here. All about credit. This is one of the problems why people can't get loans, is that their credit isn't fine. So watch this video. It talks all about credit, how to fix it, what you can do, how to contest things. And if you have any questions, comment below, and I appreciate you watching.